In 2015, the National Treasury introduced the tax-free savings account with the hope of improving the overall savings rate of South African citizens, as they kind of hoped that this will in effect lessen the burden on the government of providing for those in need after retirement. Now, it is definitely not very common to receive a gift from the South African government, especially with regards to saving on taxes. So it would absolutely make sense to take this opportunity on with both hands and squeeze the most out of it. So in this video, I will be going over exactly everything that you need to know about a tax-free savings account in South Africa so that you can realize the beauty of this type of investment and hopefully open your own if you don't already have one. Now guys, you can literally save hundreds and thousands of rands in taxes with a tax-free savings account. So please do not let this opportunity pass you by. At the very least, watch this video all the way to the end and then decide for yourself if this is something that you would want to invest your hard-earned cash in. Now, we all know that we need to pay taxes on basically everything. There's no way around that, except if you want to end up in jail. And this also includes your investments. But in order to understand why tax-free savings account is so important, you will first need to understand what taxes you will be paying on different types of investments and how this will impact your long-term growth and financial well-being. So, what taxes are normally payable on investments? The first one is interest tax. Now, typically, bonds and cash that are stored in unit trust investments will incur interest tax. Now, the interest earned from any South African source is exempt per annum, up to an amount of 23,800 for those younger than 65 and 34,500 for those older than 65. The second one is dividend income tax. Now, dividend tax received by individuals from South African companies are generally exempt from income tax, but another type of tax is then applied called dividend tax at a rate of around 20%. Now, this is withheld by the companies paying the dividends to the individuals, which basically means that 20% of your dividends will be held back before the balance is either paid out to you or reinvested. And the third one is capital gains tax, or CGT. Now, when you finally decide to sell a part or all of your investment, you will need to pay tax on the gain or profit that you made. This is known as the capital gains tax. Now, a portion of your capital gains tax will be added to your other income for that year, and you will thus be taxed at your marginal tax rate. The CGT tax rate can range from anything between 7 and 18% depending on your tax bracket. And only 40% of capital gain is included, and there's also an annual exclusion of 40,000 rand. Now, with all of that out of the way, let's look at what a tax-free savings account is. Now, a tax-free savings account allows you to invest in various asset classes, be it a money market, fixed term bank account, a unit trust investment, or even a JSE listed exchange traded fund. Now, the great thing about this is you don't have to pay any income tax, dividend tax, or capital gains tax on the returns of these investments. And as you can imagine, this will already save you a ton of money. Now, there are some rules of the tax-free savings account that you need to be aware of. Number one, you may only contribute a maximum of 36,000 rand per year. This is within the South African tax period, which runs from 1 March to 28 February each year. And if you exceed this limit, then any contributions over and above this amount will be taxed at a rate of 40%. Ouch! Don't do that, please. So, it is really important to monitor your tax-free savings account across all approved accounts regularly to avoid exceeding this limit, obviously. Number two, you have a lifetime limit of 500,000 rand on contributions. So, if you invest the full 36,000 rand every year, you will reach the limit in about 14 years of time. Number three, you may open several different tax-free savings accounts, but the limit still applies to the total contributions across all of these accounts. Number four, you may withdraw money at any time from a tax-free savings account, but this really is not advised, as it cannot be replaced and will permanently reduce your tax-free savings limit, as any contributions thereafter will count as a new contribution. So, for example, if you contributed 30,000 rand and withdrew 10,000 rand, then the maximum that you can contribute for that year will stay at 6,000 Rand, not 16,000 Rand. So in other words, you can't top up your tax-free savings again after withdrawal, and any withdrawal will result in you forfeiting your tax benefits, while at the same time wasting part of your lifetime contribution and losing out on potential investment returns, which is not ideal at all. Okay, number 5, any unused contributions will default to 36,000 Rand again in the following year. So for example, if you only contributed 30,000 Rand for 2021, then in 2022, you can still only contribute 36,000 Rand, not 42,000 Rand. So it's kind of a case of use it or lose it. Number 6, a tax-free savings account is not subject to any regulatory limits in terms of where the money can be invested. So in essence, this will allow you to diversify away from South African markets. Number 7, you can invest whenever you like and can even choose to invest a once in a year lump sum if that is your preference. Number 8, you may switch your tax-free savings account from one financial institution to another. However, the transfer can only be carried out between the two service providers. Now this is important. You will not be able to switch to another financial institution by withdrawing your funds from your tax-free savings account and putting them into a tax-free savings account with a different provider, as this will be classified as a new contribution. So make absolutely sure that you don't make this crucial mistake. Number 9, you can open a tax-free savings account in the name of your children. However, you must realize that you will then be using part of their tax-free allowance, which may limit their ability to save for themselves via tax-free savings account later in life. Also, any money withdrawn can only be paid into a bank account in their name. Number 10, note when returns on investment, meaning the interest you earned, are added to the capital contributed, the balance may exceed both the annual and the lifetime limit. The capitalization of these returns within the account does not affect the annual or lifetime limit. For example, if a person invested 36,000 Rand for the 2021 year of assessment and the returns on investment is interest of 5,000 Rand, which then is capitalized, the total amount in the account will then be 41,000 Rand. The interest amount of 5,000 Rand will then not be regarded as a contribution. And finally, number 11, when the holder of a tax-free savings account dies, the account will form part of that deceased person's estate and estate duty will then still be applicable. Now, the term savings account is not accurate and actually rather unfortunate, as this can easily confuse uninformed people and cause them to make bad financial decisions, as they will regard this as a short-term savings account, such as an emergency fund, of which the funds are easily accessible to fund any unexpected expenses. And this could not be more wrong. A tax-free savings account should rather be renamed to a tax-free investing account, as only through the power of long-term compound interest and savings on that interest, dividend and capital gains tax will you really see the beauty that this account has to offer. You must think of a tax-free savings account as a long-term investment for an absolute minimum of 15 years. This means that you can afford to take on a higher risk tolerance and will therefore make more sense to allocate the majority of your portfolio to growth assets, which has kind of proven in the past to outperform more conservative asset classes such as fixed income, property and cash. Now also remember that if you are under the age of 65, you receive an annual tax exemption of 23,800 Rand per year on all interest income. And over the year of 65, the exemption increases to 36,500. So assuming you receive an annual interest rate on your savings of 5%, you would need to have at least 476,000 Rand under the age of 65 and 690,000 Rand over the age of 65 in your tax-free savings account before you receive a single Rand of tax benefit by using a tax-free savings account for interest-bearing investments. Therefore, a tax-free savings account will only really start working in your favor if you target the growth asset classes, which underlying assets pay dividends or trigger capital gains tax, which you are now exempted from in your tax-free savings account. Investing in the long term gives your money a better chance to grow and kind of cushion you against the market volatility. It is also really important to try and minimize the fees and taxes on your tax-free savings account, as this will also influence your growth in the long run. Now here's the big question that you probably want to ask. Peter, will I be able to retire comfortably by just investing into a tax-free savings account? Well, the answer is yes and no. And it really depends on when you would want to retire and how much you think you will need per month after retirement. So to keep things simple, I will give you two examples. For both, I am assuming that your investments will get a 6.5% return after inflation, which is quite conservative, considering the fact that equity returns of 15% have been found in the past over the long term, and inflation in South Africa has been, on average, around 6%. Now, I will also assume that you'll be able to contribute the full 3,000 Rand per month until you reach your lifetime limit, and then leave your money until retirement at the age of 65. Okay, so let's have a look. If you start investing at the age of 51, you will just reach your maximum contribution limit of 500,000 Rand at the age of 65, which together with the interest, your investment will be worth around 818,000 Rand. Now, using the 4% rule of retirement, this means that you'll be able to withdraw safely around 2,730 Rand per month for the rest of your life. Well, that is not much, is it? But let's say you start at the age of 18. You invest the same 3,000 Rand per month for 14 years and then leave the money to gather compound interest for the next 47 years. You will then end up with a whopping 6,953,000 Rand of retirement money at the age of 65. Now, if we use the same 4% rule of retirement, you'll be able to live comfortably on just over 23,000 Rand per month just from this one investment. And if you can find a spouse that is able to do exactly the same, you can easily double this amount. And if you ask me, this is quite a lot to retire on, and many of us will be quite satisfied with that amount. Now, I can appreciate that not everyone is able to put down 3,000 Rand per month, especially not at the age of 18. And not everyone has the pleasure to still be that young. But the purpose of these examples is to show you the absolute power of compound interest and that it is never a better time to start investing than right now. You may be somewhere in the middle, but even so, this investment can still provide a healthy boost of retirement savings, especially considering the fact that all your dividends, interest and capital gains will be tax-free. Now you may be wondering, where do you open a tax-free savings account? Now, an important thing to remember is that a tax-free savings account is usually only a small part of the big overall investment portfolio. And everyone has their own goals, timelines and risk appetite. And although I cannot give you any financial advice as to where you need to invest your tax-free savings account, we can look at the current personal financial giants in South Africa and see where they are invested. Now, I may make another video about this in the future, but in the meantime, I will link down in the description to an article by Stealthy Wealth where he kind of evaluated the investment portfolios of 9 experts in South Africa that you can have a look at if you are interested. Now, if you are completely new to investing, then you may feel a little perplexed as to how best to approach your tax-free savings investment. So remember, in these tax-free savings account, hitting your allocation every year is way more important than what you choose to invest in. If you are not yet comfortable investing on your own, then get a financial advisor for the interim until you find your feet and are comfortable enough to invest yourself. Do not put off investing into your tax-free savings account because you are scared that you may choose the wrong platform. As long as you stay within the guidelines that I mentioned in this video, just start, even if it is in a bank account. You can always move your tax-free savings account, but you can never make up for lost time, as compound interest is truly the core principle on which tax-free savings accounts is built upon. Thank you for watching, guys. If you found this video to be helpful, I would really appreciate it if you can leave a like on this video, share it with one friend, and if you are interested in videos with regards to personal finance, investing, entrepreneurship and life hacks, then make sure you subscribe to this channel. Now, I also made a video on retirement annuities that I would highly recommend you go and watch, as well as how a tax-free savings account compared to a retirement annuity. Both of these are very good mediums for long-term investments, so make sure that you watch both the videos and the comparison so that you'll have the best idea of where you want to put your hard-earned money. And as always, have a lucky day, and I'll see you in another video next week. Cheers!